Good morning, students. I welcome you all for the online class of business studies. Today we will be continuing the chapter business finance. In that we were learning the dividend decision. So let us recall about the dividend decision. The 11th point was control. I already explained to you that if the shareholders of the company are ready to share their control over the business with other new members, then they can issue the new shares in the market. But if they don't want to share the rights over the business with other partners with a new one, then they can prefer the borrowed fund if they can so that way we are seeing that the equity shareholders are considered as the owners of the company, and they have complete control over the company. They take all the important decisions for managing the company. The debenture holders have to say in the management, and preference shareholders have limited right to vote in the annual general meeting. So the total control of the company lies in the hands of the equity shareholders. If the owners and existing shareholders want to have complete control over the company, they must employ more of debt securities in the capital structure, because if more of equity shares are issued, then another shareholder or a group of shareholders may purchase many shares and gain control over the company. So if they don't want to share this type of control, then equity shareholders select the director, who is constituted the board of directors, and board has the responsibility and power of managing the company. So if another group of shareholders get more share, then chance of losing control is more. Debt suppliers do not have voting rights, but if large amount of debt is given, then debt holders may put certain terms and conditions on the company, such as restriction on payment of dividend, undertake more loans, investment, long-term funds, etc. So we cannot say only even if we are issuing the shares and getting the more and more shareholders, then control will be shared. In the case of debt also, when we are taking more debt, then the debt supplier can also make a control over our business in indirect way, long-term funds, etc. So company must keep in mind type of debt securities to be issued. If existing shareholders want complete control, then they should prefer debt, loans of small amount, etc. If they don't mind sharing the control, then they may go for equity shares also. Regulatory framework, when we see issue of shares and debentures have to be done within the SEBI guidelines, and for making the loans, companies have to follow the regulations of monetary policies. If SEBI guidelines are easy, then companies may prefer issue of securities for additional capital. Whereas if monetary policies are more flexible, then they may go for more of loans. So if we will say statutory framework, issue of shares and debentures have to be done within the SEBI guidelines, and for taking loans, so there must be some regulatory framework under which it must be decided whether it has to be issued the shares or whether it has to be taken the borrowed fund. Companies have to follow the regulation of monetary policy made by the SEBI, Securities Exchange Board of India. If SEBI guidelines are easy, then companies may prefer issue of securities for additional capital. But if monetary policies are more flexible, then they may go for more of loans. Stock market condition, when we see, there are two main conditions of market, that is boom period and boom condition, and recession or depression condition. These conditions affect the capital structure, especially when companies planning to raise additional capital. Depending upon the market condition, the investors may be more careful in their dealings. During depression period, means when companies facing continuous loss situation in the market, business is slow, and investors also hesitate to take risk too. So at this time, it is able to issue borrowed fund. Securities as these are less risky and ensure fixed repayment and regular payment of interest. But if there is boom period, means continuous profitable year, business is flourishing, and investors also take risk and prefer to invest in equity shares to earn more in the form of dividend. Capital structure of other companies. When we see the capital structure of other companies, some of companies frame the capital structure according to industrial norm, but proper care must be taken, as blindly following industrial norm may lead to financial risk. Okay, so whatever industrial norms are there, we must see it, we must continue it with the following by observing whether it is good or not. If firm cannot afford high risk, then it is better to go equity, not take borrow fund from the market. because other firms are raising. Now is the fixed and working capital. The point, business finance is also required for arrangement of fixed and working capital. These two capital are very important. Fixed capital, as you know, for machinery and other types of goods, it is very important to arrange fixed capital, because fixed capital is not, if not arranged, then definitely business cannot be possible smoothly. So fixed capital is very important, like for machinery, buildings, land. Anytime business requires this capital, so that arrangement is needed. Fixed capital involves allocation of firm's capital to long-term assets or projects. Managing fixed capital is related to investment decision, and it is also called capital budgeting decisions. The capital budgeting decisions affect the growth of the profitability of the company, definitely, because fixed capital investment is not very small. It is a big investment done once in a year, and after doing it, many company have to face many problems of finance. So it is very important decision what way fixed investment can have to be done, which fixed investment is needed, which fixed investment is not needed. It can be done in future period of time. So long-term asset bring benefits over a long period of time, and investment in this asset involve huge amount of funds. The capital budgeting decisions include purchase of land, buildings, plant and machinery, change of technology, expenditure of advertising, campaign, research and development, etc. Factor which is needed, requirement of fixed capital. Investment in fixed asset is for longer duration and is called fixed capital. Fixed capital is financed through long-term sources of finance, such as equity shares, preference shares, debenture, long-term loans, etc. The requirement of fixed capital depends upon various factors which are explained below. Very first, nature of business. The type of business company is involved is the first factor which helps in deciding the requirement of fixed capital. A manufacturing company needs more fixed capital as compared to a trading company, as trading company does not need plant, machinery, etc. Second factor which we have to keep while taking fixed capital decision is scale of operation. The companies which are operating at large scale require more fixed capital as compared to the small scale companies, as they need more machinery than others, whereas small scale need less amount of fixed capital. Technique of production. If labor intensive technique is used, definitely fixed capital will be less required, but if capital intensive techniques require more fixed capital, so it is up to the technique of production which company is maintaining, the fixed capital have to be maintained. Technology upgradation. Industries in which technology upgradation is faster need much more amount of fixed capital, like fashion designing and software designing, everything. As and when new technology is invented, old machine become obsolete and they need to buy new plants and machinery. Whereas companies where technological upgradation is slow, they require less fixed capital as they can manage with old machines. Growth prospect, when we see companies which are expanding and have higher growth plans require more fixed capital, has to expand, they need to expand their production capacity, and to expand production capacity companies need more plant and machinery, so more fixed capital is needed. When we see diversification, every company want diversification. Company which have plans to diversify their activities by introducing more range of products require more fixed capital, so as to produce more product they require more plants and machinery, which means more fixed capital. Availability of finance and leasing facility. If companies can arrange financial and leasing facilities easily, then they require less fixed capital as they can acquire assets on easy installments instead of paying huge amount of at one time. On the other hand, if easy loan and leasing facilities are not available, then more fixed capital is needed and companies will have to buy plant and machinery by paying huge amount together. So this was the stability of finance and leasing facility. If companies arrange financial and using facilities easily, then they require less fixed capital. Okay, but if they cannot available the lease facility, means no one is able giving them credit on easy term, it is better to maintain fixed capital at a large level of collaboration. Joint ventures. If companies are preferring collaborations, means together they want to work, joint venture, then companies will need less fixed capital as they can share land and machinery with their collaborations. But if company prefer to operate as independent unit, then there is more requirement of fixed capital. Now comes working capital. After the fixed capital gets over, it's no points where how it is to be accumulated. Now is working capital, the second part of the capital. Day-to-day expenses and operating activities which the company bears, it is known as working capital. Working capital have to be maintained by company in a long way, because if any day working capital is not there, it is very difficult to handle the business. So working capital refers to excess of current asset over current liabilities. This refers to the investment in all the current assets such as bills, bills receivable, prepaid expenses, inventories, etc. These current assets get converted into cash within an accounting year. Examples of current assets in order to liquidity are cash in hand, cash at bank, debtors, marketable securities, finished goods inventory, bills receivable, work in progress, raw materials, prepaid expenses, etc. Net working capital or working of capital. If we want to know net working capital or working of capital, this refers to excess of current assets over current liabilities. Current liabilities are to be paid within a period accounting year, that example bills payable, creditors, etc. Current liabilities are sources of fund for acquiring current assets. Suppose company get credit for maintaining stock, then stock which is current asset gets created with the credit purchase which is currently liability. Okay, so company get credit for what? Maintaining stock, then stock which is current asset will get what? Created with the credit purchase. The net working capital can be negative also when current liabilities excess current assets. The net working capital indicates the liquidity position of the company. The positive net working capital implies positive liquidity positions, whereas negative net working capital indicates weak and poor liquidity positions. Now, factors affecting the working capital. When we talk about factors which are affecting the working capital are as follows. Very first, the firm must estimate its working capital very accurately, because excessive working capital results in unnecessary accumulation of inventory and wastage of risk capital, whereas shortage of working capital affects the smooth flow of operating cycle and business fails to meet its commitment. So, finance manager must estimate right amount of working capital. The finance manager must keep in mind following factors before estimating the amount of working capital. Length of operating cycle. The amount, very first thing. The amount of working capital directly depends upon the length of the operating cycle. The operating cycle refers to the time period involved in the production cycle. So, if the length of the operating cycle is large, definitely large working capital will be required. If the operating cycle is small, then where it will be required less working capital. Nature of business. Yes, it plays a very important role. The type of business firm is involved in is the next consideration while deciding the working capital. In case of trading concern or retail shop, the requirement of working capital is less, because length of operating cycle is small. The wholesaler has compared to retail shop require more working capital, as they have to maintain large stock and generally sell goods on credit basis, which increases the length of the operating cycle. The manufacturing company requires huge amount of working capital, because they have to convert raw materials into finished goods, sell on credit, maintain the inventory of raw material as well as finished goods. Scale of operation. When we see the firms operating at large scale need to maintain large more inventory, debtors, etc. So they generally require large working capital, whereas firms operating at small scale require less working capital. Business cycle fluctuation. During boom period, the market is flourishing, so demand of the goods increases, more production, more stock, more debtors, which mean more working capital. Whereas during depression period, low demand, less inventories to be maintained, less debtors, so less working capital will be required. Now comes seasonal factors. The working capital requirement is constant for the company which are selling goods throughout the season, whereas the company which are selling seasonal goods require huge amount during season, has more demand, more stock has to be maintained, and fast supply is needed, whereas during off season or slack season demand is very low, has so less working capital is needed. Okay, so it depends on the season also of the product. As in the season of the product is there, demand will be more, but if the season is not there, it will be demand less, so we have to maintain the inventories. Technology and production cycle. Technology and production cycle plays a very important role. If a company is using labor intensive technique of production, then more working capital is required because company needs to maintain enough cash flow for making payment to labor. Whereas if company is using machine intensive technique of production, then less working capital will be required because investment in machinery is fixed capital requirement and there will be less operating expenses. In case of production cycle, if production cycle is long, then more working capital is required because it will take more long time for converting raw material into finished product. Whereas production cycle is small, then it will be taking less time. So lesser funds are tied up inventory and raw materials, so less working capital is required. Credit allowed. A credit easily allowed from the market. Credit policy refers to average period for collection of sale proceeds. It depends on the number of factors such as creditworthiness of the clients, the industry norms, etc. If company is following liberal credit policy, then it will require more working capital. Whereas if the company is following strict or short-term credit policy, then it can manage with less working capital also. Credit availability. Another factor which is allowed to credit policy is the how much demand for how much and for how long period the company is getting credit from the supplier. If suppliers of raw materials are giving long term credit, the company can manage with less amount of working capital. Whereas if the credit available by the supplier is less, then definitely working capital has to be maintained by the company in a big way. Operating efficiency. When we talk about operating efficiency of the company, the firm having high degree of operating efficiency will require more working capital, whereas the firm which require low working operating expenses, they will require less working capital. Availability of raw material. If raw materials are easily available and there is ready supply of raw material, then any input the firm can have low working capital. But if they need not maintain any stock of raw material, so they can manage with very less stock. Whereas if the supply of raw material is not smooth, then firm need to maintain large inventory stock, carry on operating cycle smoothly. Level of competition. When we see the level of competition says if the market is competitive, then company will have to adopt liberal credit policy and to supply goods on time. High inventories have to be maintained, so more working capital is required. But if the level of competition is small, it is less, then monopoly market is there, then they can have less working capital also, as they can only fulfill the demands of the goods. Inflation. If there is increase in or rise in price, then the price of raw materials and cost of labor will rise. If it will result in an increase in working capital requirement. But if company is able to increase the price of price of its own goods as well as there will be less problem of working capital. The effect of rise in price on working capital will be different for different businessmen. Growth prospects. Firms planning to expand their activities will require more amount of working capital. As for expansion, they need to increase scale of production, which means more raw materials, more inputs, etc. So more working capital also. So this was the chapter business finance. I hope you have understood. Thank you for today's class. Next class we will be having some revisions of the previous classes.